Here we've talked about institutional investors, but who really makes deals come and work, that does the greenfield investment, that really helps and knife the deals we need to finance? It's really the banks. And of course, we've had a wonderful phenomena of the growth of African banks. And so I'm really pleased to chair this session, which is going to talk about the planning and strategies of African banks, how they've been successful to date, and what do we need to just keep on growing that success so we can get more deals done. And I'm very honored to be able to present James Mwangi, the CEO of Equity Bank, and ask him to tell us about his success story and highlight what he sees as the investment opportunities that exist both within Equity Bank Group and how investors can participate successfully in the growth of the company going forward, and any other messages that need to be told to the private sector and to our friends in the public sector. James.
Thank you very much. In terms of success, let me frame it in two perspectives. In terms of impact as a bank, and two, as an investment opportunity for investors, because in the house we have very good investor. Let me acknowledge from the onset an anchor investor, Richard, NSSF from Uganda, among others in the room. But basically, Equity turned from a microfinance organization, a building society, 10 years ago, 2005, and became a bank then. 2006, listed in Nairobi Stock Exchange and started, and that is the opportunity that it created to give the investing community a chance to participate. But prior to that, two opportunities arose. The first one was Africa, the first dedicated microfinance fund for Africa based in Senegal. And Equity became the first investee in the year 2002. They exited 2006, and I guess for every dollar that they had invested, they got $80 back. It was the most rewarding investment. Then the second opportunity came after listing 2007. We really needed capital to expand. We did a term sheet globally, and eventually Helios won the bid. And they made an investment of 185 million. Those who remember, it was on the eve of the global financial crisis and Kenya's political post-election crisis of 2007. So essentially, those two combined to make it very tough to create a return. But I'm happy to say the $185 million, Helios exited the last 3 months. That's a value of nearly $500 million in 7 years. And essentially, two things were proven by Helios, that you can invest and exit out of Africa seamlessly without hanging effect on a stock, because during that period, during the year, Equity appreciated by 30% in terms of value. So when you have 500 million exit from a Nairobi Stock Exchange, it reflects liquidity. There is liquidity. There is good investors willing to take up new stock. Going forward, what is the opportunity for Equity Bank? Equity Bank has been the greatest beneficiary of those two significant investments. In 2007, when we rang the bell in Nairobi Stock Exchange, the market cap of Equity was just 4.6 billion Kenya shillings. If you use today's exchange rate, you divide it by 100. Today, Equity is nearly 170 billion. Just before the erosion, it was slightly over $2 billion US. So yes, the equity funds made a great return, but the organization itself grew by almost 100 times within a very short time. From a balance sheet of 20 billion when Helios invested to a balance sheet in excess of 420 billion Kenya shillings, or $4 billion US dollars. And now with the presence in 6 countries, Kenya, Uganda, South Sudan, Tanzania, Rwanda, and DRC Congo. So, and the customer base increasing to over 10 million customers, making it the largest bank in terms of customer base in Africa. And in Nairobi Stock Exchange, the biggest bank in terms of market capitalization. So both the bank won and the investors continued to grow. Impact on, while Equity started as a microfinance bank 10 years ago, it's now maybe arguably the biggest SME bank in Africa. 70% of the asset base is in the SMEs segment, helping a lot of people to create wealth, creating a generation of local businesses that are becoming regional and essentially helping to grow the economy. When we did the last tally of how many people are employed by Equity Bank customers, we went to about 800,000 employment within the customer base. Equity itself has employed 9,000 professional bankers. So essentially, you could see the contribution to the economy. But lastly, as I close, because I had only 5 minutes, which I'm now on the fringes of being edged out by Barbara, is the innovation Equity has brought into the market. As people say, Equity has democratized banking in the East African region and made it possible for masses. When we started off nearly as a microfinance 20 years ago, only 4% of the Kenyan population had a bank account. That number has grown to 57%, with Equity having half of all the customers in Kenya. So we could see the significant contribution to the economy in one aspect or the other. Second aspect of it is redefining philanthropy. Equity offered its infrastructure to do good. So teaming up with the foundations and development institutions, Equity has used its infrastructure to convert 500,000 peasant farmers into agribusinesses. It has 10,377 orphans in secondary schools on scholarships, and has 265 bright Kenyans in Ivy League schools in the US, creating the next generation of leaders. So our success is not about purely money. It's good to reward shareholders, but it's transforming an economy and impacting in what we call shared prosperity within an ecosystem. It's bringing everybody on board and taking pride that you can redefine. 2 great innovations it has brought. The first one is agency banking. In addition to 270 branches, Equity has 20,000 agents who represent it in every shopping center. So the banking bridge the last mile when the shopkeeper is the one who takes deposits and manages withdrawals and originate loans and also originate insurance policies. So essentially, that's the biggest contribution of really making financial products accessible. The second last one is we all have enjoyed internet banking for many years. Converting the Fisher phones is old Nokia 100, into almost smartphones by installing them in a SIM card that has banking software. And essentially, getting every customer to have a banking platform that compares with internet banking, but on an ordinary Fisher phone. So those are contributions that the world is speaking. And lastly is lobbying globally. I sit on both the advisory board in Kenya on financial sector, chairman of Kenya Vision 2030, advisory board of IFC on SME, the G8 and the G20, specifically on inclusive banking. So that is in a total sum what we could call the success of Equity Bank. Shareholders who have been there for 20 years, 15 years, each of them out of one share, out of splits and bonuses, they have 600 shares. And the 600 shares, the value has gone 30,150 times. So that is a measure of equity success. Thank you, Bob.
I mean, it's astounding. It is truly astounding. And, you know, as Elizabeth from the head of OPIC said yesterday, in many political circles, we have a problem where the public sector doesn't trust the private sector. I think we have to bring James in all those cases to help us with the divide. It's just breathtaking, the scope of what you've done. And I think Africa and the world thanks you for that. Thank you. We're going to proceed to Sigan Abaji, CEO of GT Bank, he's going to stand up, but he swears he's going to time himself 5 minutes. And for those of you that were here yesterday, he got a wonderful award. And he's going to tell us more than he told us yesterday about his success today and the opportunities that he sees within his strategy and how investors can participate.
Thank you very much. I promised Barbara 5 minutes. The reason I'm standing is I'm really jet lagged and I don't want to go to sleep. And when you're jet lagged, it's better to talk standing. Thank you very much. My name is Segun Agbaje. I've worked in Guarantee Trust pretty much all my life. Guarantee Trust Bank is a bank that was set up in Nigeria in 1990. As most people would know about Nigeria, it's the good, the bad, and the ugly. And the idea was to create an oasis in Nigeria, to create a world-class bank that you could put anywhere in the world. On the journey towards doing that, Guarantee Trust listed itself. It had 42 shareholders on day one, capital of $5 million. In 1997, in order to grow and start a journey towards creating an institution, we listed the institution by introduction on the Nigerian Stock Exchange. This was a $5 million company. We also decided that since what we wanted to build was an oasis, we needed to start to live life very differently. We were a small bank, high-end, wholesale, 12 branches. In 2007, we decided to list the bank on the London Stock Exchange, which we did successfully on the main exchange and raised $820 million. We also started to do a lot of international financing. We issued our first Eurobond unsecured in 2007, again listed on the exchange. Having been a small wholesale institutional bank with this kind of capital, we started to redefine what this organization was. And we decided that we were going to go from small to large. And that rather than stay high-end wholesale institutional, we were going to start to build a retail base. For those who are very familiar with banking, when you do high-end institutional, that's where all the margins are. There's a lot of margin pressure. And so we started to build a retail customer base in 2007. We had 80,000 retail customers at the time. And we figured out that if we could build this retail base and lend the monies in the high end, we would run a pretty successful model. I'll still let you know where we've gotten to. So from 80,000 customers, today we have 7.3 million customers. In supporting our high-end wholesale institutional business, which is basically the traditional oil and gas, manufacturing and everything, we then have now a very robust retail business that accounts for 42% of our deposit base and about 10% of our loans. Guarantee Trust Bank, historically, I became CEO in 2011, has had a net interest margin of over 8%, return on equity of close to 30% year on year, return on assets of over 4%, and all this is built on what I call a very efficient cost-to-income ratio, about 40-something%. This is how we lead our lives. So in going forward, we've also basically decided that retail wouldn't be there just to support the high end, and we started to embrace a lot of what I call very disruptive technologies, and that rather than let people come to us and take our businesses away, we were going to go to them. In banking young people, we found that young people find the websites of banks extremely boring, so we created something called Indani, which is an online TV channel which does sports, entertainment, whatever, and it's really aimed at people under the age of 30. We have about 4 million hits a year on Indani, skits, and once we bring you onto Indani, we know we'll bring you into our main system. We also started a market hub because we didn't really have an SME business. And everybody says that the greatest impediment for SMEs is access to loans. And so we went back and said, why don't they have access to loans? Because their cash flows are not good enough. So we created a market hub to give them other channels of distribution. If we're able to boost their cash flows, then the money will come. We have mobile banking. Our mobile banking, most people in Africa, as was said before, don't have smartphones. So our mobile banking platform can work on smartphones and work on what you call USSD, which are basically, you don't need to have any mobile access to do transfer, to do any type of banking, and we have that. Having been fairly successful in Nigeria over the last, since I've been CEO, we've made a profit of over $651 million every year. We decided that maybe it was time to start to look outside of Nigeria. In 2011, we were the 15th most profitable bank in Africa. As of 2 years ago, we went up to number 6. With the devaluation, we've dropped to about number 9, but you know, we'll keep going. The company that started with $5 million about probably 6 months ago had a market cap of $5 billion. Today we have a market cap of over $4 billion. And what I always tell people is that the top 3 banks in Africa are South African, but that in the next 3 to 5 years, Guarantee Trust will be one of the top 3 banks in Africa. We make today 93% of our income in Nigeria. And people ask me, you have 170 million people, why do you go outside Nigeria? Well, we are going outside Nigeria because we're going to take that contribution to about 15 to 20%. Outside of Nigeria, we're in every Anglophone West African country. We're in one Francophone West African country, which is Cote d'Ivoire, and we're in 3 countries in East Africa now, Rwanda, Uganda, and Kenya. By the end of first half of next year, we'll be in Tanzania. We are not going to proliferate just for the sake of it. We're going to go into high-impact countries where at least we can get 15 to 20% of our profit outside of Nigeria. If I look at the future, I don't think we're going to change dramatically. I think we're going to continue to push retail. We're going to build a very strong SME business. We're going to continue to build this African franchise, which today accounts for 7.5% of group, and we'll take that to 15 to 30%. What we promise our investors, people who have invested with us, and hopefully there might be 1 or 2 in this room, is that at the very minimum, we will give you a return on equity after tax of 25%. We've delivered on that in real terms, in dollar terms, over the last 3 to 5 years. In fact, we've been closer to 30%. And that I will also not go to the market to raise any new equity. We will put back at least 40 to 50% of our profit into capital. So the only way to really invest in Guarantee Trust is to buy the GDRs on the London Stock Exchange or the Nigerian Stock Exchange. We will not raise capital. We will refinance ourselves and continue to build enormous wealth in our current shareholding structure. Thank you.
Wow. Well, who was it yesterday that said, where's the youth? I think you still qualify. Where's the innovation? Where's the innovation in you? Okay. You just steamrolled over us. That was like amazing. Where can we say? That was great. Thank you. Thank you. So, Rafiq, yes. Are you going to stand up or are you going to sit like the rest of us old ones?
I'll just sit.
So next, Rafiq. This is Rafiq Bengali, the general manager of UBA. If Rafiq, can you please sell us UBA and outline how investors can participate in your company's growth and where you see all going? Thank you.
I'll give it my best shot. Ladies and gentlemen, thank you for being here. Thank you for presenting me the opportunity to speak on behalf of UBA. First, I'm just going to tell you that I'm not going to sell you anything today. So just be relaxed. I've been asked to sell UBA, but I think UBA should sell itself. I'm here to speak to you about the huge opportunities that exist for UBA and thus its potential investors, partners, as well as customers. My colleague has already spoken about the opportunities in all of Africa. The last 2 days we've been hearing about the African growth story. And in order to take advantages of these opportunities, UBA has the strategy and the capacity, which means management, talent, infrastructure, capital to execute as a Pan-African bank with an African-focused strategy. The bank has positioned itself to be Africa's global bank, and I'm sure a number of banks also have that same strategic goal. We are already present in 18 other African, mostly underbanked countries outside of Nigeria. And there's a key global, and we're also in the key global financial centers like New York, London, Paris. We need to execute, our strategy. There's 4 tactical strategic thrusts going forward. One is earnings optimization, cost efficiency, asset quality, and the African consolidation. We, as others, would also hope to be one of the top 3 banks in each country that we are in Africa. Within the African context, UBA is on the cutting edge of technology. We have 1,600 ATMs, 3,500 point of sales, terminals. We cater to the retail, commercial, and the corporate sector. Obviously, also to the parastatal as well as the government organization. Obviously, also the overall model to mobilize cheap, low-cost funds through various branch and other channels, and then deploy them into loans and other investment to maximize returns to our shareholders. We are market leader in most of the markets that we operate in, with a good market share of the key parameters, deposits, loans, etc. The bank is uniquely positioned, again, in various African markets, supporting the largely unbanked and informal intra-regional trade, working with various countries to provide infrastructure and support commodity and export market development. Have the funding and the liquidity. We have the ability to create assets, quality assets, and also on the profitability side. I cannot say that UBA has RO, the return on equity, as good as my colleague from GT Bank has mentioned, but we are pretty close. We have about 25% instead of 30. The NIMs are pretty, also good. Again, that's the strategy to grow the NIMs. We are at 6.5 versus my colleagues at 8%. And that's why, I think the potential for UBA is great going forward. We are listed on the Nigerian Stock Exchange. I think the current trading is at about 4.24 Naira. It's a significant discount at about 50% to book. It's one of the most liquid investment on the Nigerian Stock Exchange. The valuation is very attractive and compelling because we have, I believe, no place to go but up. It's one investment, multiple return. I would describe USA stock as an ETF for Africa. Thank you.
Thank you. Isn't it wonderful to hear return of equity, not so high, but 25%? I mean, oh my word, hats off. That's really impressive. Okay, our last speaker is Hashish Thakkar, co-founder of Atlas Mara. So if you could tell us about your new banking platform and what opportunities exist for investors and how to engage investors going forward.
Thank you. Thank you all. It's a pleasure being here. We're a very new bank. Bob Diamond, my partner, and I came up with the concept of Atlas Mara over 2 years ago, and we listed on the London Stock Exchange about 21 months ago. So we're a pretty new platform in that respect. In the first year, which was 2014, we managed to do 4 acquisitions in 3 regional trading blocks with presence in 7 countries with over 450 branches. And we were able to build an amazing management team, and we have a fantastic board. This year has been our first half of the year where we've been in control of the bank and we've been running them. And we were able to bring NPLs down, increase revenue, bring down the cost of funding, increase NPL coverage, and get more deposits than loans. So it's been a phenomenal first half of the year that we've been in control of the bank. What's unique about Atlas Mara is the fact that, we've tried to create the best of global with the best of local. Bob's experience in global banking has been phenomenal with what he did with Barclays Capital and Barclays overall, and obviously with ABSA, etc. But then his real passion for Africa combined with Mara's expertise and understanding of the continent. But also still being very institutional, obviously being on the London Stock Exchange and having many regulators, yet remaining very entrepreneurial has been something that we, as Atlas Mara, have been very proud of. And lastly, trying to create the combination of doing good and doing well at the same time. The opportunity is phenomenal. I, as Mara Group, prior to setting up Atlas Mara, have been on the receiving side of financial services for about 17 years. So obviously felt the need that the opportunity is absolutely huge. And when you think about Africa is not going to be immune to the global situation of that, what's taking place. But when you think about our core fundamentals in terms of real growth, the middle class segment increasing, the opportunity to truly become innovative. I think James and Shegun both touched on this, but our continent has been able to leapfrog in so many different ways, from mobile money, which today 42% of Kenya's GDP is pumped through mobile money. But mobile banking needs to be financial institution-led, and that needs to be the next big wave. So our hope, and we are very firmly on track, that we want to become a positive disruptive force in financial services on the continent. And we don't see ourselves in more than 12, 15 markets, and we're already in 7. So this is just the beginning. Thank you.
In the earlier panel, we talked about retail products. Wouldn't you invest in these guys? That would be great. So we only have a few minutes because we have to end on time. So we will move quickly into Q&A right now. Yes, Ashley.
Hi, gentlemen. It's a fantastic panel to see you all together. I work for African Alliance. I represent the investment bank here in America. And I'm proud to say that we actually worked with Helios on the sell down of Equity Bank to the NSSF very recently. My question is to all of you. You're all growing your platforms across Africa. If you're going to do it organically, that's fine. But a lot of you are doing it by acquisition. And there's only so many good banks out there. There are only so many banks that don't have enough capital that could do with your injection. How are you going to do that successfully without giving too much away to the rest of the panelists? I'd appreciate some perspective. Thank you.
Well, part of the question that I'd like to answer is I don't think that all the banks are growing just by acquisition. I mean, in our case, we've got brownfield and greenfield, and growing with starting an operation as well. So it's a mixed. It depends on the opportunities that present themselves, and then the banks look at that. So it's not always acquisitions. Sir.
Okay.
Yeah, you're on.
I do. Okay, I think it's similar with us. Of our 9 franchises, we've done 4 acquisitions and 5 greenfield. So it depends what the opportunities are. I'm actually very open. We're going to Tanzania. We're going to go greenfield. We're going to look at Mozambique. Maybe we'll do an acquisition. I think there's still, in most high impact countries in Africa, a lot of small banks. And what you find is that as capital increases are happening, a lot of people who open tiny family banks are realizing that they have to get out of it, and that there will still be opportunities. I'm a very timid person, so I'm actually very scared of acquisitions. Due diligence never reveals everything. So it's a real balance. But I think that if you wanted to grow by acquisition, there are enough tiny banks in a lot of the countries where the family owners need to get out of those banks.
I think it requires a balancing act because one, scarcity of skills and competencies. In some markets, particularly challenging markets, if you get an engine that is functional with the right human capital, it becomes easier to enter. But equity in the 6 countries, we have only entered through acquisition only in 2, Uganda and DRC, so essentially.
I think if I can just comment, I think, our strategy so far has been acquisition. And obviously Nigeria is a unique market, but typically across the countries where we're going to have presence, we've been pretty firm that if we're not in the top 3 to 5 position, we don't want to be in those countries. So organic growth and acquisitions is going to be a natural way to go about it. To Shegun's point, due diligence and etc. is challenging, and therefore I think that's the bigger opportunity. So if you're able to do that well, and if you're able to then integrate that into your bank overall, I think that's but there's plenty of good deals out there, to the point of people want to be a part of a bigger picture as well. So it's not necessarily fully exiting people all the time.
Another question? Yes, Mahesh.
It's a pleasure to be able to ask a question of a market where I'm active. I'm advisor to one of the banks in Nigeria for 5 years, another one for once in the past, so I know a little bit about the banking system. What I'd like to ask you, and also it's great to be in the presence of maybe the only billionaire we have attending the conference today, so thank you for being here. Maybe there are more, I don't know, given the valuations in the market, perhaps there are. You talk about equity markets and 25% growth and 30% growth, yet the banks in Nigeria, most of them are rated, well, the big ones are rated. Zenith, GTB, UBA, Access, Union Bank that you own, they are rated, but not very highly. When you talk to rating agencies about 30%, 40% growth rates, they shudder. When you talk about equity markets, they love it. So how do you balance the need for capital through equity, for which you need the growth, versus the confidence that the rating agencies need to have to give you the top ratings that you need for other kinds of financing?
Okay, let me try and help out here. First things first is, you know that your rating can't be higher than the sovereigns. So if I could be cheeky, I'll say that my rating is constrained by Nigeria's rating, and that if it wasn't for Nigeria, we'd have better ratings. I mean, we have NPLs of below 3, capital adequacy tier 1, 21%. We tick all the boxes, but we're predominantly a Nigerian bank, so we're constrained by the sovereign. But rather than sell my franchise for cheap, which I alluded to, the profit is strong enough, where if you keep your dividend payout ratio at about 50–55%, and you're putting back in capital about $350 million a year, then guess what? We'll never need anybody's equity until the day we get the ratings we want.
I think if I add a little bit there, investors are now going beyond ratings because they are also ranking and comparisons. If you look, for instance, globally, the banker, Equity Bank last year was rated the 4th most efficient bank in the world. I should have said with a return on equity of 35% and a return on asset of 6%. So essentially, then investors go beyond these ratings, and how do you rank these investments in terms of return? When you look at solidness in the same rating, equity is ranked the 68th most solid bank in the world in terms of ratios. So the ratio speaks more than rating because of that constraint. Equity Bank will never be rated higher than the Kenyan rating. So it is not the African banks that are rated, it's the African countries that are rated.
But just to build on that, I think when you think about capital markets as a whole, in Europe, 80% of banks' debt sits on their own books, whereas in the US, they've securitized it. So I think thinking about developing our capital markets down the line in terms of securitization, et cetera, is going to be playing a crucial role as well, and that will, I think, help on an overall perspective, which I think is important.
I think my colleagues have already discussed that ratings cannot be better than the country where you operate out of. So that's one piece. And then, my take on this is where is the beef? Investors really want returns. Obviously, the ratings are constrained, but ratings don't necessarily mean that we don't have the kind of returns that the investors want. So.
And we see for the local pension funds, that's not an issue. Yeah. So we had a question, I believe, over here. Okay. Oh, sorry.
Good afternoon. Ellie Page Jabrell. I'm based in Washington, D.C. I'm a strategist and advisor to the public sector and private sector on 5 continents. And my question is really for the panel, where we're hearing about some of your customers who are taking fixed assets and getting loans and really shopping around from one bank to the next and not really having an infrastructure for the banks to know who's bringing free and unencumbered collateral or assets. I'm just curious in terms of how you might be discussing amongst each other to know that you really have verifiable retailers and loans as well.
If I talk about Kenya, the situation is not as may be reflected. We have a comprehensive RAD registry, which all mortgage registry. And also, all these are registered also along with the business registry office. And if it is asset backed like, let's say, things like vehicles, again, the registry is very functional. In addition, we have credible reference bureaus that have both positive and negative information on our clients. So we no longer need to compare between ourselves because the registries are functional.
Okay, well, in the case of Nigeria, it's funny, it's still 2 stories. In the corporate space and probably middle market where you have hard security, that's not really a problem. The land registry has everything and mortgages are registered. The bigger problem is when you go into the retail space because you don't yet have, like Kenya, a sophisticated credit bureau, which is why in the Nigerian banking system today, there's a biometric project being done. We reckon we have about 30 million bank accounts, about 20 million people have been registered. So by the time we can tie you to your biometrics, then it'll be easier to start to build a credit history for retail. But in the other end of security, there's no problem. It's really in the retail, but I think we're probably 6 months away once we finish the biometric project.
Yeah.
Okay. We have a question here, and then I see another one in the back. You guys have inspired a lot.
Thank you. Ahmed Dumondé from Côte d'Ivoire. My question is, this is a very exciting story, and I'm very hopeful when I see and hear this, particularly on 2 fronts. The first one has to do with bringing essentially the millions of Africans out of the woodwork where nobody has a bank account, extremely difficult. So I would be more than happy to hear from what Equity Bank has done. How do you foresee being more aggressive, and certainly some of your colleagues here, in terms of increasing the ability of some of the millions of Africans who don't have a bank account to be part of the system? And the second thing is SMEs, and I'm glad that you really are emphasizing on that, because there's some very interesting thing happening. You have most of African countries now embark on this, doing business, a program that the World Bank has to improve their, business environment. At the same time, there is difficulty for some of those SMEs that we are bringing from the informal sector to the formal sector to have access to adequate financing. So my question to all of you is that I guess the last panelist actually just spoke a little bit about that in terms of what can be done to essentially improve the ability of SMEs to have access to the financial market. Thank you.
Okay, well, I think he's more of an expert on financial inclusion than I am, but I'll try. I mean, the central bank in Nigeria has helped by creating what you call a Tier 1 account. It has limits, but at the end of the day, the KYC requirements are minimal. And that's why what we've done is, I told you we're partnering with a telco, and literally all you have to do is press *7370, and within 1 minute you'll open an account, and we'll use the documentation that you have with the telcos. So that is really going to push financial inclusion. From our perspective, you can come down in the pyramid. In terms of SMEs, just like I said, there's a lot of capacity building that you need to do. We cannot run away from SMEs. I always say, if you look in Nigeria, everybody's an SME. Even those in paid employment have SME businesses. So What you have to do is give them some capacity. A lot of SMEs have found don't even know the difference between turnover and profit, so they tend to run into trouble. You have to give them other platforms where they'll grow. And so working with things like the World Bank, the IFC on professional capacity building for SMEs. Also, the central bank has a fund called MSME Fund, which has like first loss guarantee. So we're going to have to take a bit of risk on the SMEs, but we're going to have to give them the capacities to grow, and there's no running away from the SME business. For us today, it's only 8% of our business, but we're hoping it'll grow in the future.
I think the challenge of SME is not that it is not a big opportunity and a very good opportunity. It's the amount of effort that is required to bank SMEs. One, most of the SMEs are in the small and micro segment where they don't even keep books. So essentially what happens is that it makes banking SMEs labor intensive. You have to have the right people with the right attitude to rebuild and to reconstruct the books of accounts. The second one is building capacity in your clients. You have to invest in building your clients. Over the last 3 years, Equity has trained 1.3 million of our clients on a 12-week financial literacy program. And now we have embarked on the most promising 25,000 on a 3-year entrepreneurship program. But that investment is worthwhile when you look at that segment, because it's, banks are not very good at it. We're able to maintain a net interest margin of 10 to 11%. And we're also able to make 45% of our income from non-interest income, despite that. So essentially, what you really need to do is to be committed to invest in that segment, to unlock it. So it requires upfront investment. And then it builds enormous loyalty. Our top SMEs have now been with us for maybe 15 to 20 years. So they are in cycle of 12 to 15 times of borrowing. So you have sufficient information on them. You have helped them build the asset. You have built the trust and loyalty. And then it becomes very, very easy. But upfront, you have to have the capability to train, capability to construct the account, and particularly from expenses, not from books. It's by discussion. So that is the hard part of it, but it can be done. Lastly is that you have to have understanding regulators, because when regulators create regulatory frameworks and requirements that are punitive to banks because of banking SMEs, then banks become shy. So Kenya, we have been very lucky that the government has digitalized the national identification system. So you can log in and be able to verify almost everything about the registration. And second, has adopted what one would call smart regulation to encourage that segment. If you look last week, but one, they created now a Companies Act that focuses on SME other than the traditional corporate companies. So that is support from government and regulatory framework makes it possible.
I think if I can just add, I think the technology angle is absolutely crucial. So, you know, bringing the informal sector into the formal sector. I mean, we have a mentorship program across the continent where we're supporting over 1 million entrepreneurs today. So I think it's the whole ecosystem approach of how you've got to really look at it. And if you think about a lot of the banking sector across the continent historically has been, you know, taking customers' deposits and putting it into government treasury, not typically lending to SMEs. And I think that's a huge opportunity which, you know, some of the panelists on the table are addressing and needs to still be addressed in a huge way, because that's really going to be our answer to really building the economy as a whole as well. So genuinely doing good and doing well combination, which is trying to create a bank for business in the true sense.
So my colleagues have basically covered the whole spectrum. I would just add also that there are good examples that we can take from, for Grameen Bank in Bangladesh, you're talking about, you know, microfinance. It's an example out there that can be, you know, utilized by institutions to, you know, go there. But there's a long way. There's a long way to go, and I think all the institutions are working hard on that challenge.
You know, it's really tough here. You know, I've been told the next panel is here. We're on a very tight deadline. Can I encourage you to meet up with the person or persons you want to ask the question with? And I'm sorry about that, but it's like, you know, but again, I mean, this is extraordinary. And, you know, we have a wonderful future. We've got to really thank these guys for sharing with us. Unbelievable. And I want to see how many people our friends and the development partners have trained versus your, what was it, 1.5 million?
1.3.
1.3 million. A special clap for that. That's one of the things.
Doing business in Africa, you can't afford to be without Africa Investor.